What if I told you that there is one mistake that property owners make all over Australia every single day that gives the banks control over all of your assets, and if something goes wrong, they will take the lot? My name's Jack Henderson, and I'm the founder of Henderson Advocacy. I've built a $40 million property portfolio before the age of 30, and I started my investing journey when I was 18 years old. And I made this exact mistake that I'm going to run you through, and I had no idea about the repercussions. And now we buy 500 plus properties a year for clients, over $500 million in transactions per annum, and I make sure every client is aware about this mistake before they make it. The first thing we need to understand is really what equity is. So I'm going to assume that by you watching this video, you have your own home. Now let's say that this home was purchased for $1 million. Let's use round numbers. You bought the property for $1 million. Now when you purchased the property, you put in your 20% deposit, which was $200,000, and you paid $50,000 in stamp duty, and you took $800,000 from the bank. So you put in your 20% deposit, you gave the government their $50,000 for stamp duty, and you took $800,000 off the bank. Now, you essentially have $200,000 worth of equity in that property, because essentially what equity is it's the gap between your mortgage and what the property is actually worth, which is $1 million. Something to note here. Most banks, for most people, there are certain exemptions or exceptions, will only allow you to borrow up to 80% of a property's value. So you can see here, if it's $1 million property and you've borrowed 80%, that equals the $800,000, and you've put in $200,000. Now what happens? Over a period of time, that property that you paid $1 million for grows. And again, I'm going to use round numbers. Let's say you owned the property for a period of time and it grew from $1 million to $1.5 million. So it's had $500,000 worth of growth. And let's assume that over that same period of time, you've paid your mortgage down from $800,000 to $700,000. So you've paid off $100,000 from your mortgage, and over the same period of time, it's grown by $500,000. Now, what happens is the gap between the mortgage and the value of the property, which is the equity, has grown. And now there is an $800,000 difference. So you went from having $200,000 worth of equity, which is the money that you put into the deal originally, to now having $800,000 worth of equity. But remember what I said before, you can only access, for most people, up to 80% of the property's value. And 80% of 1.5 million is $1.2 million. So the bank will allow you to access up to 1.2 million. You've got $700,000 worth of debt, which means there's the potential for you to access $500,000 worth of equity, which is amazing. But this right now is where people can get stuck. So I'm going to run you through two concepts. One is the right concept and one is the wrong concept. The two concepts I'm going to run you through is an equity release and cross-securitization. So we'll do cross-securitization first. Now, we understand that we have our home, okay? It's worth 1.5 million now. And like I said, our debt on that property is 700,000, which means we've got 800,000 worth of total equity, but only 500,000 worth of available equity, because the bank will allow us to borrow 80% of this number. Now, assume that we want to go buy an investment property. We are smart people. We've paid down some debt. Our property's grown in value and we want to put this money to work. So what cross-securitization is that we go find another property. Okay? Here's property number 2, investment property number 1. And let's say that, to use round numbers again, we go and buy this property for $1 million. Just the same as what we bought the first property for. And the numbers are also going to be similar. We need to come up with $200,000 for the deposit, and we need to come up with $50,000 for the stamp duty and the costs. We need to come up with $250,000. But you, as an individual, only have $50,000 of cash. Okay? So you can't use your $50,000 of cash because you need $250,000 to buy the property and you don't have enough cash. what the bank will do is they will allow you to use this $500,000 of equity to securitize, or essentially to use as collateral to buy this property. Okay? So what securitization means is they will use this property security, being the $500,000, to secure this property, which essentially means what happens is these properties are joined together. I'll show you on a page which is less messy. So we have our property number 1 and we have property number 2. Okay? So with cross-securitization, what happens is these two properties are tied together. They're securitized together, which is what cross-securitization means. And what that means is, let's say the bank, here it is, the bank now has control over both of these assets because they are securitized against one another, and you can only cross-securitize assets with the same lender. So you have to keep both properties with the same bank. And this is the mistake that I made with property number 1 and property number 2. The first property that I bought, I did the exact thing that I just showed you. I put my deposit in, I got the money from the bank, amazing. As I went to buy property number 2, I happened to just go back to the same bank because I didn't know about anything else. And they said, absolutely, Jack, you can buy the next property. And I said, great. They said, here's a pre-approval for whatever it was, $900,000. But they didn't give me any money. I still didn't have any money for the deposit because the money didn't come out of the property. It's still sitting in the property as equity. So one of the issues and one of the downsides is for a deposit for the property, you either have to have cash in the bank, which is the $50,000 that I mentioned. Lots of people don't want to use the $50,000 because that's their buffer or that's their money for a rainy day. So what most banks will do is they will give you this thing called a deposit bond, which is a piece of paper that essentially says, this is a insurance policy that if Jack Henderson doesn't come up with the money, essentially the bank will fund the deposit, and then essentially the bank will come after you as the individual to get their money back. But the issue with a deposit bond is it's not real money. You can't go deposit it into someone's account. It just is a piece of paper that you give to the vendor of a property, which means not a lot of vendors will accept a deposit bond because it's not the cash in the bank. There's no hurt money in it from the buyer's point of view. So that's one of the main issues to begin with, is you have to come up with a deposit bond, which means it's going to exclude you from a lot of transactions. Now, the other issue is the bank has control, right? The bank has control of both assets. Now, a lot of people don't actually understand what this means. So, property number 1, like I said before, it's worth $1.5 million. Okay, second property here, it's worth $1 million. Okay. Now, let's assume the worst happens. For some reason, the property here that was worth $1.5 million stays worth $1.5 million. But the property we bought for $1 million, let's say we bought an off-the-plan apartment. You can't buy any worse than an off-the-plan apartment, so don't do it. But let's say we paid $1 million for it, and then for some reason, and this happened to my parents, over a period of time, the property that we paid $1 million for is now worth $700,000. It's dropped by 30%, $300,000. Guess what? Because these properties are tied together, if you wanted to go do something else with the equity in this property, because this one is tied to it and this one has dropped by $300,000, it now affects the equity position in this existing property. Because they're tied together, if you wanted to go and get just a valuation done on this one at 1.5 and use the equity that's available just in this property, they will say, and they being the bank, well, this property's equity position has decreased, and because it's decreased and it's tied to this, we're going to have to make sure that the decrease is spread across multiple properties because we have securitization over both of them, which means they don't allow you to access equity or do things with properties siloed. Okay, so they have control, and they also, let's say that you wanted to go buy a property with another lender. So to begin with, I had bank number 1, they bought me, or allowed me to buy, I should say, the first 2 properties. But when I went back to bank number 1 for property 3, they said, no, you're not buying a third property because based on our serviceability calculations, you can't afford it. And I said, okay. That's when I found out about a mortgage broker. That broker said, Jack, I can get you money, but we have to go to bank number 2. And bank number 2 looks at your situation differently. They'll include things like overtime, which the first bank wouldn't include, and they will lend you the money. And I said, great. The broker said, but because the bank's got control over your first 2 assets, we need the cash for the deposit, and you can't go and do an equity release from the first 2 properties, which I'm about to run you through. So you're a little bit stuck, and we have to undo this to be able to go and use bank number 2 to continue to grow your portfolio, which is annoying. Okay, so the issue with cross-securitization is you give one bank control over multiple assets. Those 2 assets are then tied together, and what that means is that if anything was to ever happen with one or the other assets, because they're tied together, it affects both of them, or it can affect 3, 4, 5 of them. Not ideal. And then also, when you try to buy properties, you don't have the cash for the deposits, which means you have to use a deposit bond. Again, it's inefficient. It'll exclude you from a lot of transactions and a lot of negotiations, which is not ideal. Now, you probably ask, well, Jack, why would anyone ever do this thing called cross-securitization? I'm glad you asked. So, the reason they would do it is because people, this is the bank, okay? The bank. Most people are this thing called LAZY. They're lazy. Now, to do a cross-securitization loan, you don't have to go through and get multiple approvals done. There isn't a multiple step finance application. It is essentially a pre-approval, go and find a property. Super straightforward, super simple. So it's because lazy brokers or lazy bankers don't want to do multiple applications. It is also because of this thing called control. Banks want to have more control over you as a lender because it gives them more security, and if something was to ever happen, they have more equity and more capital to be able to fix the problem. So it gives them more control. It's because people are lazy. And the third reason is because most people are uneducated, and they allow this to happen because they don't know what they don't know, which was Jack Henderson when he was 18, 19 years old. So that are the 3 reasons. Now, let's go through and understand the second option, which is the smart option. It's what rich people do. It's what smart investors do. It's what Jack Henderson now does. So we have an equity release. It is, okay? In simple terms, this is what an equity release is. So we have our house, like I said. This is the one that we bought for $1 million. It's now worth 1.5. We've got 700 of debt against it. And that means we've got 800 of equity. Okay. Again, we can't access all this equity because the bank will only allow us to borrow up to 80% of this 1.5 million, which is 1.2. You've got $800,000 of available equity, and they will allow you to access up to $1.2 million. So the difference between this number and this number, which is our current debt level, versus what they will allow us to access up to, is $500,000. Now, we know what happens with a cross-securitization. You have this equity available, but instead of getting the money out of the property, they just securitize it against the next property. So what happens in an equity release is we have our house and we have our existing loan of $700K loan. Okay. That's the existing loan that's on the property. Now, because this first property is an owner-occupier property, this $700,000 is non-deductible because we pay for it with after-tax income because it's our own home. Now, what happens when we want to do an equity release is there is a second loan that comes off, okay? And let's assume that we pulled out that whole 500 grand, okay? So that's 500,000. This is loan 2. So now we have 2 loans attached to the same property, or securitized, like the cross-securitization. It's securitized against the same property. Now, this 500,000 comes out into what is called offset account. And it comes out as 500K of cash. Okay. So we have an offset account, 500K of cash is sitting in that account. And as we draw down on that money, we start paying interest on it because there's 500,000 of cash sitting there. We've got a $500,000 facility. And obviously, as we use that money, we start paying interest on it. Okay. So we've now pulled $500,000 of cash out of our investment property, and our total loan, being 700 plus the 500, is now 1.2 million against a property That's worth 1.5 million. Okay, so we're at an 80% what is called a loan to value ratio, LVR. Existing loan of 700, non-deductible, owner-occupier mortgage, $500,000 of equity. Instead of just using this equity to securitize another property, we've pulled it out as an equity release loan. It comes out, it sits in an offset account, and we now have access to $500,000 in cash. So we go back now and we do the same scenario. We've now got our property here. It's worth 1.5. We've got 1.2 of debt against it. And we've got 500K of equity sitting there, which is cash. Now, when we want to go buy property number 2, just to remind everyone, it was $1 million property. And what do we need? We need $200,000 for the deposit. And we need $50,000 for stamp duty and costs, which means we need $250,000 of cash or equity. Guess what? We've got $500,000 sitting here in an equity released loan sitting there in our offset account. So what we do is we use $250,000 of this money as the deposit and the costs on property number 2. So now we have property 1, property 2. Property 2 is worth $1 million, but it's only got $800K now of debt against it. Okay? Because the $250,000 deposit is secured against this property. Now, these properties could be with 2 completely separate lenders. We don't need them to be with the same lender because we've got the equity that's out of this property, which means we can go and use that cash as a deposit to any property and any lender. And let's then say we want to go buy property 3. What we can then do is go to a completely new lender. It could be a second-tier lender. It could be a non-bank lender. It could be with another major lender. But it gives us options and selections. If, for example, we had these 2 properties, and this is our old owner-occupier property, if we wanted to upgrade the owner-occupier property, but we had an investment property that is securitized against it, which is the cross-securitization structure, and like I said, this property's value had decreased from $1 million to $700,000 because you bought the wrong asset, you can't just go and sell this first owner-occupier property and use all the equity that's in it because there was negative equity in the second property, which means the bank's going to want to recoup that negative equity before they give you what's left of the owner-occupier. So they have control over the whole situation. But if you did the equity release loan structure that I'm running you through, you could sell this property, you could sell this property, you could sell both properties and have just a third property. You have so much more selection and control over which lender you use, what you do with the properties, and obviously what you do with the cash. And you can then also refinance if you wanted to buy property number 3, these first 2 properties. So you could pull equity from this property, you could pull equity from this property, and then use that money to fund the third, which is exactly what I did. So for property number 3, I used property number 1, property number 2. Like I said, this one's now worth, let's say it's worth 1.8 now because we've held it for a few more years. This one's worth 1.4. The debt against this property is 1.2 from our equity loan, and we still have $250,000 left in the offset account from the first purchase. This property's worth 1.4. We've only got 800 of debt against this one. We can access up to 80% of this 1.4, which is 1.12 million. The difference between 1.12 and 800 is 320,000. So what we could do is we could use the 250,000 of equity release that we had left over from property 1, release this 320, combine them both together, which would give us 570, and then use that money as the deposit for property number 3. And these could all be with separate lenders. This one would be with CBA, this one could be with ANZ, and this one could be with Pepper, for example. The main reason that you want to do an equity release loan over cross-securitization is because you, as the borrower, have more control. You can do what you want with the money. You actually have cash that comes out of the properties to sit in an offset account, and you can go and choose when you buy, what you buy, whether you use that cash or not. That's another thing. If we have our house here and we have our, let's say we have our equity releases, like I said, there was 570 grand of equity release from the other two properties. For example, that 570,000 could sit in our offset account for 10 years. And we never use that money and we never pay interest on it. But if the worst was to happen, we have this money sitting there as a buffer, which means if we lost our jobs, if we needed to take time off work, having kids, we want to go traveling, whatever it is, this is our money. We can go and use it when we want. Obviously, as we use it, we start to pay interest on it, but it's cash in an account. And I have this rule where if I need cash, I'd rather be looking at it than looking for it. So just before we wrap up the video, 3 things that you need to know to make sure that your loan structure is right. Number 1 is if you do not have 2 loans when you are buying an investment property that is tied to the first property and you don't have a big chunk of cash that you can use for the deposit and stamp duty, then you are not doing an equity release loan, you are doing a cross-securitization. Number 2 is if they say you have to use the same bank for both purchases, you are getting a cross-securitized loan. And number 3 is if your broker says, I'm just getting you a pre-approval, go out there and find the property, and you say, where am I going to get the money for the deposit from? And they said, use a deposit bond. Again, you are getting a cross-securitized loan, and you should definitely ask about the equity release and the differences between the two and why they have recommended the cross-securitization. So if you want more videos like this, where I actually break things down step by step, run you through the pros and the cons of different options, comment below what you want me to break down, and I'll be doing more videos like this to make things easier for you to understand so you can take control of your financial future as opposed to giving the control to someone else to control you.